Good to have you with us this morning. As we were mentioning, it is a busy day in the markets with an avalanche of earnings for investors to digest. Tech in particular will be in the spotlight. We've got Alphabet and Microsoft reporting later today, and more tech big names reporting later this week. And we're going to have more on those stories as we roll through the program. But beyond earnings this week, all eyes will be on the most closely watched central bank, the U.S. Federal Reserve, led by Jerome Powell. It'll announce the latest move on interest rates tomorrow. Most economists expect the Fed to leave rates unchanged for now, but there are growing expectations we will see a rate cut by, call it, May or June. Now, keep in mind, a year ago, given this rate hike cycle, many on Wall Street warned of a recession and possibly a painful one. Looking at the current state of the U.S. economy, we certainly have seen a lot of layoff announcements, but the economy on paper seems to be managing through relatively well. Consumers have continued spending. The unemployment rate remains near a half-century low. And perhaps most encouraging for the central bank, inflation has been moving back towards the Fed's desired level. Now, a key question going forward will be how long the headline numbers on the economy hold up with rates at their current level. It's also an election year in the U.S., and despite the Fed's independence, political pressure is always lingering in the background. Now, I mentioned we are seeing record highs for the American stock market. The idea of rate cuts plays a role in that rally, with some betting lower borrowing costs will help, for example, boost earnings growth. Meantime, the Fed decision follows the Bank of Canada's time in the spotlight last week, with Tiff Macklem and his team inching towards a dovish policy pivot. But there are plenty who, when you compare Canada to the U.S., see an economic picture that is weaker. Our first guests this morning have been talking for months about the likely reversal of rates in this country. David Rosenberg is founder and president of Rosenberg Research at Devlin, is with Devlin Capital, former head of Canadian portfolio management at PIMCO. We are pleased to welcome both of them back. Nice to see both of you.
You too, John. Thanks for having me.
Can we start with Fed expectations this week? What should investors be ready for, David?
Well, the only thing that really matters right now is the timing of the first rate cut. So the Fed already pretty well told us that the rate cycle is over. The question really is going to be magnitude. But for today's meeting, I mean, there's no dot plots. So it's going to be, the markets right now are leaning 50-50 towards March, pretty well fully priced for May, June. As far as the markets are concerned, I know this is very myopic because what does a couple of months really mean unless you're a trader? So this is really a question you're asking from a trading perspective is, where's you going to lean? By the end of the day tomorrow, will the markets be fully priced for March, or will they price it out entirely? But the key is that rates are coming down. It's probably, if it's not March, it's going to be May or June. So the only thing that really matters is, how he massages his message for, whether or not March is going to be the first cut. That's all that matters.
And I know you're the bond market guy, but in the stock market, we've been seeing, at least in the U.S., these all-time highs. And one thing that keeps coming up is this idea that maybe too many rate cuts are priced into the expectations in the U.S. for 2024. So the difference between not just a change in policy, but the extent to which we see rate cuts, I guess at the end of the day, does the state of the economy determine that?
I think absolutely the state of the economy determines it. And I find it a little interesting that the U.S. bond market is more aggressive in the rate cutting cycle, given the momentum in the U.S. economy right now is stronger than Canada. Now, granted, their policy rates are, 0.5% higher than ours, but, I think the Canadian economy actually looks a lot more vulnerable than the U.S., so I find that a kind of an interesting situation.
So, David, I mean, you've actually been pretty cautious on the U.S. economy, broadly speaking, but just if we're comparing Canada to the U.S., what do you see right now?
The Canadian economy is far more fragile, and we've been talking about this for a long time, that you can mask an erosion in the economy through unprecedented immigration and population growth. But real per capita income and output, the Canadian economy on that basis already is in a recession. And the big difference between Canada and the U.S. is that there's no CHIPS Act here, right? There's no monumental fiscal stimulus. The fiscal stimulus in Canada, in terms of incremental impact on GDP growth, is done. In fact, the only country in the world that's still stimulating through fiscal policy is the United States. Yeah, I know you're saying, well, the data in the United States so robust, so on and so forth. 2/3 of the growth last year, 2/3 of the 3% growth in the U.S. economy came from fiscal stimulus. So things are so great that they still have to basically pump the steroids in from the fiscal side and run these gargantuan deficits. So, no, I'd say that that's probably the big difference between Canada and the United States on that basis is the state of fiscal policy.
U.S. economy weaker, in your opinion, than some would suggest because there's a stimulus consideration, but then when you compare the U.S. to Canada, you see even more weakness for the Canadian picture.
Canadian economy is far weaker, and don't forget that the U.S. is a large closed economy. Canada's a small open economy. We are a torque on global GDP. But we just got numbers out of the EU today. Their economy is flattening. Asia right now is not doing well at all. Look at the Chinese economy is deflating and exporting its deflation around the world. Well, that has a big impact on Canada because we're 3 times more sensitive to the global economy than the U.S. is.
So at the end of the day, Ed, I think there's a lot of Canadians who would appreciate a change in interest rate policy, right? Especially we've got this sort of tie to the housing market. It doesn't just make your borrowing costs higher. It makes more complicated housing stories around things like rentals and all that kind of stuff. But of course, people also don't like inflation. And so throughout this whole episode, people have said, well, if this exercise is going to bring inflation to normal levels, maybe we should be ready for more of this hawkish talk until there's clear signs of that. But I feel like in my conversations with both of you, you've both felt like there's enough evidence that the inflation trend is improving significantly, that rate cuts are warranted. Is that fair?
Oh, absolutely fair. The only thing I would say is, and I've said this, I don't know how many times, but this has been kind of an unprecedented post-pandemic recovery, and there's been lots of kind of wonky things that have happened, everything from supply chains, to fiscal stimulus. So what my baseline forecast would be that just like they waited a little too long to start to hike rates because they didn't want the economy to fall off a cliff during the pandemic. My sense is they're going to wait a little too long to cut rates on the other direction because there's some momentum in the inflation data. That being, and nobody wants to be, the central banker that, lets the inflation genie back out of the bottle. That being said, I'm with David in a lot of ways, and I think that, so in other words, I think waiting a meeting or two, and then they can cut as fast as they hiked. They can cut aggressively and they can cut down. And that's kind of my anticipation.
I guess just in wrapping up this particular segment, David, there's also this talk that if they're moving really aggressively on rate cuts, it's a suggestion. This is just people say this kind of stuff. It's a suggestion that we're seeing a very fast deterioration in the economy. And what's interesting is you've got the U.S. stock market at an all-time high. You've got all these historical data points that suggest, when you have a good January, when it's an election year, when you're coming out of a bear market and you see new all-time highs, all of these things point to a nice year for the equity market. So I know in the past you've been a bit cautious, broadly speaking, on equities. You've been leaning into the idea of gold. What's your message to investors, wearing both your market watching hat and being an economist?
Well, look, I think that we have to operate on what we have certainty in. We have certainty that the rate cycle has peaked. And then the question, as I said before, is what's the magnitude? I agree with that. I don't think that they're going to be cutting rates 3 times, okay, just to get to neutral. Okay, just to eliminate the excessive restraint. We're talking about the Fed here, but it holds for the Bank of Canada too. They got to take the funds rate down to 2.5% just to get to neutral. That's about a 300 basis point decline, and you don't need a recession to get there, okay? You just need to have inflation continue to head towards target, which, by the way, it is. So I like interest rates. I like treasuries. I like anything that is correlated with interest rates. If you're in the stock market, what does that mean? Well, it means utilities. It means selective REITs. It means telecom. It means staples. Now, you would say to me, well, since growth stocks, especially tech, are the longest duration sectors of the market, why don't you like those too? And ordinarily I would, but the valuations are out of control. There's just too much earnings growth priced into these high-flying tech stocks.
All right.